When you really understand your profit and loss, then you really start to understand where the money's coming and where it's going. So today we're talking about the balance statement, all right? The balance sheet itself. So here's what we're covering. We're going to cover a common fear with all business owners. We're going to hit on that, right? What does it mean to balance? How to read it? What does right look like? And how to become more attractive to lenders. One of the most common fears when it comes to a business owner, am I over leveraged? How many times have you guys had that conversation with yourself like, hey, can I actually afford to get another loan on this property? Can I actually afford to take out a line of credit? Can I actually afford to put this on my credit card? Is it gonna make sense, right? That's one of the biggest fears when it comes to understanding what is our power and what are our resources available to us. Because we don't want to actually then fail, right? And failure can be a mix of maybe that's going bankrupt, right? Anybody ever been in fear of going bankrupt? That might have hit pretty close to home for some people at some point, right? Running out of cash or having a loan called due. A loan called due is basically saying, hey, look, I'm the lender. I'm gonna give you $100,000. I'm telling you, you have 10 years to pay me back. But we're on year 3 now, and all of a sudden the market has changed, and I don't want to wait 10 years. Do I have the right to call the loan due? And now, do we have the right? All depends on how that contract was spelled out, but almost every single mortgage has a due on sale clause or other reasons why they can call the loan due and put you into bankruptcy or push you towards foreclosure or whatever the case is, right? So all of these are fears typically that we face as entrepreneurs, as business owners. We want to make sure we're good to go. Nobody's coming. Uncle Sam ain't putting his hand in our pocket. Peter ain't coming back with Paul to come and rob us. We want to make sure we're good. So what does it mean to be in balance? By balance, what we're basically saying is there is an equilibrium or peace amongst, when we think about, who said it? For every action, there's an equal and opposite reaction. You guys remember hearing that in school? Ruben said it. Ruben said shit. He ain't creative. So by that though, that's a law of nature, right? And it's the same thing in business. A really good concept that we can look at is like, hey, look, man, I'm taking out a loan, which so many of us think that if we can get this big ass loan, oh, life would be so much easier because we can buy all these assets. Well, with that loan, there's an equal and opposite reaction. That opposite reaction is going to be, now that we have this new cash on our balance sheet, we now have a debt or an obligation to pay it back. So when we look at that though, we're thinking about all the money that's coming in. How is that really affecting us? Too many times as entrepreneurs, we're always looking for the easy button. And typically the easy button is, hey, let's bring in private money, right? We've all heard that before. Hey, let's bring in a partner who has capital. We've heard that before. Hey, if I can just get all of these if I can get 100% finance, right? Oh, this deal would make so much sense because of the investment rate or the return on investment. We've all heard that before. But because we're not actually looking at the equal and opposite reaction, we're not actually identifying the impact that it's going to have on our finances. There's several different ways that it will affect. So let's go ahead and break down this balance sheet piece by piece. And let's talk through some of these examples, okay? So if any of you have balance sheets and you guys want to pull them up, you can have them and we can kind of go through this together. You guys get an idea, but your homework will be to also pull up your balance sheet. All right, fair enough. All right, so let's first take a look at it. The balance sheet has 3 sections. It has assets, liabilities, and equities. All right, assets are things that basically bring you value. Liabilities are things that you owe or take away value. And then equity is essentially your contribution, your skin in the game. So let's break down assets. When we look at assets, we're typically going to find a couple of different options. All right, first thing, you're going to see current assets versus fixed assets, or fixed assets is also known as long-term assets. Current will always mean next 12 months, immediate access. All right, long-term means anything that's going to take longer than 12 months. All right, so when we think about current assets, we can see here bank accounts. Yeah, hell yeah, bank accounts make sense because I can literally pull the money out today if I wanted to. So I can get it in less than 12 months. You might see other things like accounts receivables. Basically means money owed to me, right? So basically, let's put it like this, Shane. me and you agree that you can purchase my vehicle on 3 installment payments. So you already sold it. You've already put the contract. You already put your personal guarantee. I sold it to you for $30,000. You only gave me 10. All right. So 10 will be on that income statement, but I'll put 20,000 right here on accounts receivables. Right. We don't really have it's not a promissory note. There's not really interest. It's just an installment payment. It's not necessarily going to be common with cash method accounting versus accrual-based accounting. All right, quick snapshot on that. We'll go into that deeper later on. Cash basically means this, man. Anytime money comes in or out of the bank, we actually count it on our financial statement. Accrual accounting is just like we talked about. It's accounts receivable. Yeah, we signed the contract. Yeah, Shane, you owe me a total of 30. So we're going to go ahead and count the difference here as 20,000. It's going to be on the balance sheet because it's still owed to me, man. You know, I'm still going to come to you. Right. So just keep that in mind. Not everybody has to have this. Now you get to decide for your company which makes more sense for you. Cash, which is a very simple method, or would you prefer to see something like, hey man, you still owe me money, I want to keep track of it. For most small businesses, cash is the most common because it's the simplest. When you start to see accrual, that's people who are selling larger companies that typically sell things like software packages or something that might be an annual type of payment distribution, or if they have large manufacturing firms, they might start to move towards accrual a little bit more because they're buying parts from a ton of different vendors or suppliers that they intend to pay off later, or vice versa, right? So that's where that's more common. Cash method is the most common for small businesses. And so when we look at other current assets, what are some other current assets? So remember, current assets are basically anything that you intend to receive within 12 months or less, right? So you can pick your poison, all right? So we just have a couple of different examples. Loans due to you. Did you issue out of private money to anybody? Promissory note or anything like that? If so, and it's due within the next 12 months, boom, it's a current asset. All these financial statements, guys, these are living, breathing documents that if you are not maintaining them, you will be confused of your financial position. So now for everybody who doesn't have bookkeepers, and they're like, oh, I do it once a quarter, you can start to see more and more that this can really impact you. You can start to see that it's very important to really track your numbers, okay? So now let's look at fixed assets. Fixed assets are anything that are longer than 12 months. So when we get right down to it, if you guys are in a holding company, a rental company, this is going to be your properties that you own. That's going to be a fixed asset. If you have a vehicle, right, that has a useful life of 5 years or more, that'll be typically a fixed asset if it belongs to the company. If you guys have any equipment, like Austin, perfect example would be you with any type of camera equipment, lighting equipment, or anything that the IRS will depreciate over more than 1 year, it will be a fixed asset. So that's where the fixed asset kind of lies in. At the end of the day, what we're doing is we're combining all of those together to figure out what our total assets are. Now we go to liabilities. Same thing here. Current liabilities is 12 months or less. Long-term liabilities are 13 months or more. Accounts payable, again, this would be an accrual accounting method. This is the exact opposite of accounts receivable. So now it's saying, all right, Shane, on my books, I'm going to say that you still owe me $20,000. I'm going to have accounts receivable on my books for $20,000. But since you still owe it, it's a liability to you, and you're going to have accounts payable of $20,000 on your books. All right. So we're starting to see how they start to balance out. So for every action, there's an equal and opposite reaction. That's the importance of a balance statement. If I take money away from this escrow account, if I draw down on a loan payment, if I pull money out of cash, where is it being balanced out? Now, guys, you don't have to be the expert on this stuff. You just need to understand the concept and have a system or a person help you actually to do this. All right, so let's look at some other current liabilities. Credit cards. Credit cards will always be considered current because if we think about it, a credit card is due at the end of every single month. Right? Every single month. I don't care what credit card you have. They're always due at the end of every single month. Some will allow you to carry the balance over, but they're due at the end of every single month. One of the most highest interest and cause of wasted expense is when it's on the simple compounding, not simple compounding, but daily compounding rates like credit cards or stuff like that. So just keep that in mind. We actually had a client, we were looking through it. He ended up paying almost $200,000 in interest payments only on some of this current credit or current liability credit. $200,000 worth of expenses. It's huge. All right, other current liabilities, loans due out, right? That's going to be if you owe the promissory note. right? It's a liability for you. Security deposits, if you guys are renters or landlords and you have basically the security deposits come in from the tenant, remember that money does not belong to you, right? So if we don't have a space for it on the balance sheet, basically what we're saying on our other financial statement is we've just made that as income. And we're trying to treat that as something that we can spend when we can't spend it. It actually doesn't belong to us. So having a section on this on the balance sheet as a liability, it doesn't belong to us. It belongs to our actual renters. And then long term is be the same thing that we talked about. Long term, if you bought a property and a rental hold and you have a mortgage, because a mortgage is 30 years, it'd be a long-term liability, right? Any type of business loan like an SBA loan or anything else that extends over a year would be a long-term liability. So another question for you guys. You got a 30-year mortgage. You don't refinance it. You just keep doing what you're doing. On year 29, does it stay in long-term or does it get moved to current liability? Current. That's exactly right. It moves to current, 100%. All right, so you guys are getting it now. All right, intercompany loans, we won't talk about that right now for sake of time. Intercompany loans, well, let me just put it like this. A lot of people love to say, oh, well, I've got 3 companies. So I'm just going to take money out of this company, move it over to this company because we need the money. And then you know what? We'll just treat it as a loan or an exchange. Here's the thing. If you guys do that and you guys are like swiping cards, for example, so company A swipes the card for company B, that's now considered commingling. All of your shit is now open for the liability protection is gone. You pierce the corporate veil just like you would if it was a personal versus business. So that's number 1. 2, Drake hit the nail on the head. It's messy as shit, right? Because now it's a question of, well, how much money is actually there? If I say it's a loan, am I actually intending to make payments on it? People will say it's a loan. I'm like, are you going to pay it off? It's like, no. Well, what the hell do you think you're going to do with it? Oh, we're just going to leave it over here. It's like, no, then now that screws up your other company's financials, right? So in reality, the best way to kind of do this is we either move it out of a company A as an owner distribution and then move it into the other company as an owner contribution. Clean and simple. It's not that you can't move it, but you just have to understand how to move it, okay? So those are our liabilities. Now let's look at the equity piece. The equity piece, again, we have owner contributions, owner distributions. Now remember, everything on the balance sheet, this is important to understand, everything on the balance sheet does not affect your taxable income. All right, on that income statement or that profit and loss, what you come out with at the bottom, that net income, that's your taxable income. Now the balance sheet can show you things that you can apply to reduce your tax rate, such as cost basis, depreciation, things like that, right? But it's not going to affect your actual taxable income. So when we look at owner contribution and owner distribution, what that means is this does not mean salary. Owner contribution does not mean salary. It means I took money out of my company and put it in my pocket because I wanted to. I'm the owner, which is perfectly fine. And that's perfectly legal. But that does not actually reduce your tax obligation. Whereas a salary, let's say you made $100,000, but you paid yourself $30,000. Well, now, since you paid yourself a salary, the company's taxable income is now $70,000, right? Because it actually treated that salary as an expense. There is a ton of different strategies that we could get into in different conversations where we can talk about what makes more sense for you. Do we take a salary? Do we take distributions? How do we combine both to get to our freedom number? All of us have a freedom number in mind. Hey, I need $10,000 a month. Hey, I need whatever. Great. Now the conversation needs to be, how am I receiving it, right? Is it through distribution, salary, profit, whatever the case may be, okay? Retained earnings, all retained earnings means is this is the profit of the company that has stayed inside the company, that we have not taken out of the company, right? So if we profited $300,000 and you only took out about $93,000, then you left the other $207 in the company. That's what a retained earning is. Just important that you guys understand that. Then we have our intercompany transactions. This is possible. Again, not saying it's a loan like we saw above, but saying that it's just a contribution from a company to another. That's okay. All right. And then net income is another possible thing. They literally take this off of the income statement or the P&L, right? They literally just take it right off of there and slap it in there. Sometimes, not all the time. So for you, now that you understand these, you guys can go back and watch the video. The question now becomes, what's more important to you? What do you need to see in here? Retained earnings, this is how much profit remained in the company. And the net income, this is carried over from the income. So let's talk about what right looks like. So now that we got a general idea of how to read this, we have to ask ourselves, what are we focusing on? What looks right? The first one is we want low debt to assets. All right, basically meaning we want more assets than we have debt. The reason why is because this is going to show us if we're over leveraged. So let's back up a little bit. And we talked about so many times investors are saying, hey, if I can get 100% financing, like a VA loan, oh, I'm in the money. Okay, great. So you go in with no money and you have this property now, and you can even transfer it over to an LLC and treat it as a business. You know, you can do all of these things, but now you're going to have extremely high debt to asset. Essentially no difference with equity. When a banker looks at this, they're saying, holy hell, you're highly over leveraged, meaning if anything goes wrong, you don't have the ability to pay this off. So this is something that we need to look at. Our cash accounts count. Our cash is an asset. This is why it's always recommended to have a reserve account of 3 to 6 months worth of operational expenses. One, it's going to protect cash flow, which we'll talk about next week. All right, operational cash flow. But two, it helps also offset your balance sheet because you have more assets than you have debt. The next one is low debt to equity. All right, as you can see, low debt is a common theme here. But now low debt to equity, what this is saying is, hey, look, how much skin do you have in the game? You as an entrepreneur, before you go out the door and you start asking for money, asking to sell a company, asking to do whatever, how much money do you have in the game? If your equity is basically zero, nilch, and you have debt, that means that you went out to, like a Shark Tank, or you went out to the SBA, or you went out to whatever, and you got all this money to start it up. And now you're basically saying, hey, look, you know what? I want a profit, but ultimately at the end of the day, I got no skin in the game. If we foreclose, we're going to walk away scot clean. We're straight. Now, as JV partners start to evaluate you, or private equity firms, when they're wanting to purchase you, they can start to look at this to say, all right, it may be easier, I'm trying to think how to word it, easier to get more out of you than you think you're worth. Does that make sense? It's kind of a long worded way around it. But essentially, hey man, you don't have any equity in this. So why should I pay you for your equity? Right? Why should I pay you for your equity? On the lender's perspective, which we're going to talk about, if you don't have any equity in it, well, you ain't got no skin in the game. Now it's riskier for me too. Right? All right. And then so many people are really worried about this. Equity is almost equivalent to what net worth means. All right. So many people are worried about I'm worth for whatever reason. That's perfectly fine. And a lot of people will value the company, and you'll hear it in the conversation. My company is worth fill in the blank, 5 million, 10 million, 15 million, but not necessarily what you're worth. Okay. And so the equity piece is basically your net worth. All right. When putting together a personal financial statement, company equity is going to be one line on the full personal financial statement. It's important to understand that, okay? We can get into that later if you guys want more details. But basically that's saying, hey, this is my stocks, my house, my whatever for me personally. This company I have this much equity in it, all right? And you'll start to see that will change as you have partners, equity partners, or whatever the case is, okay? And you're either going to have positive or negative equity at the end of the day, right? At the end of the day. Now, it's going to balance out for you on this balance sheet. That's the whole call of it. It's going to balance out. All right. So it may always look positive for the most part because it's always going to balance out. But at the end of the day, either you're positive equity or you're negative. Now, here's some things that we want to also just be aware of. Lenders care about collateralized debt. What I mean by that is a debt is actually tied to something. So here's the test. We're just going to go through it. Is a mortgage actually tied to something? His head nods. Yeah, it's tied to a property. Is a credit card tied to something? No, it's not, right? Business line of credit, is that tied to something? Typically not. Yeah, I see Ruben like, typically not. It's like a credit card, right? You just use it for other operational expenses. So when we have high debts that's in credit cards, basically uncollateralized or unsecured debt, that is not good in the eyes of a lender. The lender's going to be like, holy shit, there's a lot of debt out here that's not tied to collateral. So if we needed to go for something, the only thing that's collateralizing it is your cash reserves and everything else. So now it's riskier for us. Does that make sense? All right. The next one it's called a current ratio. And this is basically your current assets divided by your current liabilities. That's it. All right. We use this to determine, hey, do you have the ability to pay off everything coming up in the next 12 months? Do you? Right. And so if you have assets that exceed your debt, your current debts, you're going to have a ratio of 1 or higher, and you're typically good. The sweet spot, guys, is 1.2 or higher. Very similar to something else that we've all heard about, debt coverage ratio or debt service credit ratio, right? Where our cash flow needs to exceed our debt payment of 1.2 or 1.25. It's the same concept with current assets versus current liabilities. And then the other thing here, guys, asset depreciation. So with asset depreciation, say the first year you actually buy the product or whatever, and it starts to depreciate. On the second, third, fourth year, is money actually coming out of your bank account when they're using the depreciation on your taxes? Got a couple head shakes. No, that's correct. All right, so think about this, guys. $100,000 home, residential home, depreciates at a rate of $3,386 a year. I believe it might be $3,368. All right, Ruben. What that means is on the first year, you might actually pay $100,000 cash. All right. But years 2, 3, 4, and 5, you're constantly getting a $3,386 tax deduction for depreciation. All right. Now, because the lender knows that this is depreciation, it's not actually cash leaving your bank account, they're actually going to add back that depreciation to your total income. So if you depreciate $30,000, they're going to take that and add that back into your total income to get you approved for a loan. So think about this. You lose no lendability, like you still are lendable with depreciation. You paid for the item once and get to now take a tax deduction for every other year that it's being depreciated. That tax deduction that you're getting, let's say it's $3,300, that means in the following years, you're making $3,300 that is tax-free that you can now put into another investment, and we can supercharge it if we put it into a tax-free investment like a Roth IRA. Now we're talking about exponential growth and the way to navigate around taxes for many years based off of one decision we do for that year. So the conversation always comes up when we buy something, should we just treat it as an expense or should we actually move it over to the balance sheet and depreciate it? All right. And that's a conversation that we can have at a later date. But that understanding how this helps you when it comes to lenders and things of that nature is extremely important. And so here's how we're going to start today. You guys need to download your balance sheet. All right. If you guys do not have a model or a template of a balance sheet, guys, the Millionaire Real Estate Agent book, and I believe the website literally has all the financial statements you need for a real estate agent. Every single one. You do not have to recreate it. You can literally download it and copy that to the T and just start implementing it in your business. If you guys already have QuickBooks and you still feel it's like, I'm not really sure, download this one. It's free and just compare it to the QuickBooks and maybe make changes to the QuickBooks. All right. Millionaire Real Estate Agent. So fill it out completely to the best of your ability. Again, if you have a bookkeeper or a virtual assistant, have them do it, but just make sure it's complete. And then you always want to make sure it's balanced. The formula, I guess I should have said that at the beginning, is assets equals liabilities plus equity. All right, liabilities plus equity. So you just want to make sure that it's all the way balanced out there. And then you want to calculate your numbers. What is your debt to asset ratio? And what is your debt to equity ratio? All right, so this is your homework. Once you guys go through that, you're going to put together your balance sheet. You're going to calculate all those numbers that we talked about. And then you're going to talk about you're going to write down 3 practical ways that you can change the balance in your favor, right? To either reflect as more assets, lower debt, maybe higher equity.